But welcome everybody to our Business Online Business Smarts program, our ongoing session, which we've now reverted to online. This is presented by Associa British Columbia. So thank you everybody for joining us this morning. We have Rhona Stanislaus joining us today from ITI Financial. So thank you, Rhona, for joining us today. We're going to be chatting about exploring financial security with you. So excited about this session here. Give me 1 second here. Sorry about that. Sorry, computer's running a little bit slow this morning. Here we are. So as I mentioned, thank you for joining us. We do have Associa as our presenting sponsor for this. So we're just going to hear a quick word from them before we start our program here. Wonderful. Okay, great. So, and with that being said, I'm going to stop sharing my screen here and I'm going to turn things over to Rhona. Rhona has 20 years of progressive financial leadership experience within the financial services accounting industries with large multinational companies and the government. In addition, she holds a Master's of Business Admin from the Laurentian University, Chartered Professional Accountant designation, and an undergraduate degree in accounting from the University of Calgary. She values continuing education and is currently studying for her CFP designation. Rhona, thank you for joining us.
Good morning. Thanks, Heather. Good morning, everyone. Thanks for joining on this very snowy Tuesday. I think you can see the reflection coming in from my window. It's very bright with all the snow that's outside. So thanks for joining. I just wanted to take a few minutes just to expand on the introduction that Heather gave. For some of you, you may not be familiar with ITI Financial. We're a boutique investment firm that has a niche of supporting business owners and professionals. We do have personal clients as well, but typically our clients are business owners. As Heather said, I've got 20 plus years in various roles in the financial area. I joined ITI in 2018, and I support clients throughout BC, Alberta, the North, so Yukon, and the Northwest Territories. And I have clients as far east as Ontario as well. So I kind of just go wherever the clients are. And typically ITI doesn't advertise. And so we build our business largely on referral from existing clients and through our professional network. We take a collaborative approach when working with clients, and so we're keen to work with their other professionals, so accountants and lawyers, so that we're all working in the client's best interests and everyone's on the same page. So ITI stands for Investment, Tax, and Insurance Solutions, and so we work to build creative solutions based on our clients' needs in those areas, but we also can work in other areas such as advising on corporate reorgs, shareholder agreements, and things like that, retirement and estate planning. So it's a full breadth of planning that we offer. One area that we're particularly focused on is tax, and so we'll talk a little bit about that this morning, but I think a lot of advisory firms are maybe more focused on paper investments. While we do work in that area, we prioritize tax in a large way. So yeah, I think One other thing to note is just I'm not sure if any of you have worked with an advisor before, but there's a great opportunity to explore, what can be done in your own situation. We don't charge our clients directly for our time, and so we're compensated through some of the solutions we implement. So there's a great opportunity to kind of see what can be done in your own situation. But this morning we're going to talk about the way forward, and this presentation was developed just after March, this past March, when the big market correction happened, and it was in response to some of what our clients were feeling, some pressures that they were under, and so we just really wanted to kind of refocus everyone. And so we've been rolling this presentation out to clients and beyond. So I'm hoping that you'll get some great value here. So, Heather, if we're all good, I'll just look to share my screen. Okay, so this slide's titled Werno Angels, and this is really focused on, this schematic is really to explain kind of where we work. And so, we're right in the middle of it all, with clients working with whatever they have going on in their business, maybe their personal lives and also their family. So a lot of the time we're working with family-run, family-owned businesses, and so often family members involved, and sometimes all the fun that goes along with that. So, we're sort of right in the thick of things. A good example of this from my own experience is that I actually started working with ITI as a client. A longtime friend referred me to Gary Stratachuk, who's the senior partner and founder of ITI. I had heard about Gary for many years, but it wasn't until 2017 and the sudden loss of my husband in an accident that I was motivated to reach out for the referral at that time. And Gary didn't hesitate. He flew to meet with me not long after I was widowed, and when things were very foggy and emotions were running high, he was definitely right there in the middle, in the thick of things, and his approach was very relational and not at all transactional, which was something that I had been accustomed to. His approach and the solutions that he had to offer were unlike anything I had accessed previously, even as a professional. And the experience I had with Gary as a client had a significant impact on the direction I've taken since then, both personally and professionally. At the time, I was employed by the government, and my experience at that time, both from a loss and personal perspective, and then with Gary, kind of redirected my focus. So we're not afraid to be right in the middle there. So right now is a good time to talk about fear, and I've had the news on quite a bit lately, and it's very heavy focused on COVID, and so fear can really consume our thoughts and our actions. And as animals, we really only have two responses to life-threatening situations: fight or flight. And when fear sets in, we have the tendency to narrow our focus. What's right in front of you, the way out or the enemy. And with fear, with that narrowing of the focus, we have run the risk of missing out on the bigger picture. But we're not mere animals. We've been given a rational, resilient mind for a reason. And today is really about seeing the opportunity in the big picture, positively, creatively. So we're going to discuss today how all this happened in the market, what now, and how we can position ourselves to win. So for the last 3+ decades, we've been cultivating relationships with world-class economists, portfolio managers, and thinkers. Anyone can tell you what happened, but we think the real value is in having trusted advisors who can see around the corner before something happens. So the market drop wasn't a surprise to us. Last summer, we sent out an email to clients with a market update that predicted markets would soon correct 30, 40, or maybe even 50%. And in lead up to December 2019, we advised caution and clients to move more heavily into cash. Cash is certainly king in uncertain times. And if you're prepared, you don't have to participate like the masses in whatever happens. There are tools available to you so that you can prepare and position yourself. When you look at the turbulence in the market over the last 90 years, you see this type of volatility that we see in this chart. So, if you look over at 2018 and then right at the end at 2020, you can see there really, looking historically, there really it wasn't surprising that a drop was coming. The markets are driven by greed on the way up and fear on the way down. And these are two very powerful emotions. So all COVID really did was flip the switch from greed to fear. And we'll talk about that a little bit more coming up here. But we still really are proponents of patience and caution as being the best position in the next 12 to 24 months. So this slide, there's a lot going on here. We're not going to touch on it all, but I'll just kind of highlight the 4 phases that are at the bottom of the slide. So the stealth phase is a category of investor who tends to has better access to information and has a higher capacity to understand what the wider economic context is. So depending on the type of investor you or others might be, you might be entering this bubble sort of at a different point in time, so at a different phase. So not all the phases here are applicable to everyone. Some may enter and exit at different times. So those that enter in this stealth phase, these investors realize that there's an emerging opportunity, even when their assumptions are unproven. So they're kind of first out of the gates. Prices gradually increase, but often go completely unnoticed by the general population. The next is awareness. Many investors here start to notice the momentum that's happening. They're bringing additional money in, and in doing so, they're pushing prices higher. And this phase is also often characterized by a short-lived sell-off. And so this is when a few investors cash in their first profits. And, we could also see several of these sort of first early sell-offs, each one typically at a higher price than the previous. Those savvy investors in this phase reinforce their position. And really at the latter of this phase, the media starts to notice and is, issuing positive reports about wealth generating possibilities. And once this sort of media involvement happens, those getting in at this stage are increasingly unsophisticated investors. Then we're moving into what's termed as the mania phase. So at this time, everyone's noticing that prices are going up in the market, and the public jumps in for this investment opportunity of a lifetime. So there's maybe a lot of water cooler talk about what's happening, and people jumping in more on the emotional side of things. So future prices at this time are an extrapolation of past price appreciation, and this really goes against any conventional wisdom about what should be driving the market. This phase is not about logic, but more about the psychology, and being, sometimes investors feeling like they're missing out on something and wanting to be part of, something great that's happening. So floods of money are coming in and creating even greater expectations and pushing prices up to extreme levels. And, the higher the price goes, the more the investments continue to pour in. And, generally at this time, the general public that's participating here, they're caught up in the frenzy, and they're not necessarily noticing that the smart money, as it's called, as well as many institutional investors, so that would include the mutual funds, pension funds, insurance companies, and such, are starting to pull out already, and they're selling their assets. Still in this mania phase, unbiased opinion about the market fundamentals becomes more difficult to find. Many players are heavily invested and have an interest in keeping inflation going. This is, where greed sets in. And, in some cases, maybe there's some paper fortunes that are made from regular investors, and that just continues to drive this kind of mania behavior. And, everyone tries to jump in, and, some new entrants maybe have no understanding of the market and the dynamics and its fundamentals. So, with the excitement, prices are pushed up, and, really with all financial means. So this could include leverage, so borrowing, and debt as well. Then there's the blow off phase. And this is where there's a moment of epiphany. So you could liken this to, say, what happened with COVID. Something happens, and something happens, and everyone roughly at the same time realizes that the situation's changed. Confidence and expectations shift, and there may be some denial that's happening, and there may be some folks trying to reassure that it's just a temporary setback. But typically, some are not fooled for very long, and many try to then unload their assets. But during this phase, there are few takers. Everyone is expecting further declines. You could say the house of cards collapses under its own weight, and latecomers, commonly the general public and those that are less informed, are left holding depreciating assets, while those sort of savvy investors that could be in that smart money category, they've pulled out a long time ago. And so prices plummet at a rate really much faster than they accelerated at within the bubble. And the general public at this time is really considering it to be the worst possible time to invest. But again, this is a time when those smart money investors start acquiring assets at low prices. So bubbles can be very damaging, and especially for those who are more uninformed and not as savvy, and maybe who arrived late late to the game with the hope of getting something for nothing or something quickly. And you know, we see this with the March correction, that you know, people think that good times are just going to keep going, and then something happens and the bubble is burst, and here we are, still kind of in the blow off phase with all that's going on with COVID. And you know, from our view, COVID really was just the pin that burst the bubble, and that's really it. This was coming regardless. It just happened to be that COVID was the catalyst. If it wasn't COVID, we see that it would have been something else. And demographics are play an important role in what we see happening in the market. And so this is really a discussion about how we got here. So birth rates play a major role in the economy. So about 70% of the economy is driven by consumers, so people and families. And so the more people, the more products needed to serve families. And the greater the need, the greater the business. So this is very predictable. This slide shows the birth rates of the baby boom generation. And so this was a massive influx of people and consumers into the economy. And if you push these births forward to when the baby boomers entered their peak spending years and compare it to the stock market, this is what you get. So this really shows the relationship of you know, that growth of that generation and their peak spending. And so we characterize you know, spending in seasons. And so just like we have seasons, spring, summer, fall, winter, you know, we refer to each generation through reference to the 4 seasons. So we'll spend a couple minutes talking about how this largest, wealthiest, most powerful generation in modern history has impacted the markets and economy, that being the baby boomer life cycle. And so each generation can be split into these 4 seasons, 20 years per season. And each of these seasons affects the market differently. So spring is characterized by cautious growth, innovation, and a blossoming economy. So this began, if we look back at the baby boomer generation, this began when baby boomers were being born between 1946 and 1964. The world at that time was reemerging from the Second World War and the Great Depression, and new innovations were starting to occur. And as the needs of this growing cohort of people took shape, businesses started expanding their product offerings to capitalize on this growing demand. So an example of this is Gerber baby food. So as Hitler was invading Poland in 1939, Gerber was selling 60 million cans of food to new moms. Just a number of years later, by 1948, just 2 years into the baby boom, they were selling 720 million cans. So that's an 1,100% increase. So at that time in spring, it was really about innovating, serving the need, and growing to meet the need. Then we move into summer. And so by the mid 1970s, baby boomers were getting married, they were having their own children and buying their first house. And so summer is really all about innovation. So if we think back to what was happening in the mid 1970s, Apple in 1976, Microsoft in 1975, a time of high inflation, double-digit interest rates, and falling stocks. Next, of course, is fall. So fall started in the early 80s. By 1982, the average baby boomer was entering their peak earning and investment phase. Innovative companies were accelerating, inflation was dropping, and this was a really fantastic growth period. Gen Xers, they were entering their teen years, and millennials were emerging as the next largest generation. So this kind of prompted a frenzy in the real estate market. Baby boomers were demanding more space and began buying trade-up homes, and this was further fueled by low interest rates. This is kind of a fun slide. So it's really trying to highlight the connection between spending patterns and demographics and their impact on business and stock prices. So if you think about how old you were when you spent the most of your income on potato chips. So if you think about that for a minute, you might guess between the ages of 16 and 18, because that's maybe when you probably ate the most amount of chips in your life. But the real answer is 42. That's when you likely spent the most on chips. So baby boomers bought them for their teenage children who were downstairs in the basement, playing Atari and Nintendo at the time. And so when we think about that connection to the market, the next natural question is, when would have been a good time to buy Frito-Lay as a stock? And so right around 1982, holding through until most baby boomers turned 42, around 1995. So during that time, just with the amount of spend on chips, we can look back and see an increase of about 1,000%. Eventually, we hit our peak in spending, and we want to stop spending on our children and start spending on ourselves. So this comes in the form of saving, looking towards retirement, and killing as much debt as possible. If we look back at 2007 and 2008, the largest group of people collectively stopped spending and started saving and paying off debt. And so when this happens, when this heavy savings and debt repayment happens, this really sucks the life out of the economy and the markets. And so winter is characterized by debt, depression, and deflation. So it doesn't sound very encouraging, but this is really where we're at today. Nothing captures peak spending and a shift to winter more than this next example. So if we think, when do most people spend the most amount of money of the most amount of their income on motorcycles? There's a bit of a hint here with the picture of John Travolta, but yes, between 45 and 49. So if you owned Harley Davidson stocks, it would have been a good time to sell when the greatest number of baby boomers had surpassed age 49. So, nothing changed with Harley Davidson. They didn't stop making great bikes. it's just really a matter of an enormous chunk of their consumer base stop spending money on motorcycles. And so this is something that's really predictable, this spending and the connection it has to what's happening in the market. And there you can see the impact of that pullback in the spend. You know, a stock price of $74 down to just over $8. So this is just a bit of a schematic on the typical life cycle of spending. So if you look along here, I think we can all recognize ourselves at some point along the curve, and we can easily relate this to our own experience. So people today spend the most amount of money on average at age 47, and targeting and zeroing in on that age is the best way to project booms and busts into the future. So it was age 46 for the baby boomers, and as we look forward, it could be up to age 50 for the zillennials, and you know, into the decades ahead. But it's really a shift from some of the early spend on starter homes and children and trade-up homes, then looking, you know, into retirement, and then ultimately more long-term care and those kind of types of spend. So human behavior really wants to believe that life goes in a straight line, but I'm sure we all know that that's typically not how life happens. And I expect many of you can relate to this as entrepreneurs yourself. Cycles play a major role in the reality of life, and you have to be careful to guard your mindset as these things are occurring, because if you're not careful with all the cycles and things that are happening, you may have a tendency to blame yourself for something that had more to do with where we were all at in this particular cycle than something that had anything to do with you. So there's 5 dominant cycles that we pay close attention to. The first being the 45-year innovation cycle, and this cycle tracks major technological changes like the printing press, gas-powered cars, the internet. Next is the 39-year generation cycle. So this is what we just covered in a fair amount of detail. The 35-year geopolitical cycle, and this tracks trends leading up to major events like 9/11. A 10-year boom and bust cycle, and this reveals that about every 10 years, there's a financial crisis. And then lastly, the 30-year commodity cycle. And so this is particularly important for us as Canadians because, you know, we're heavily involved in the resource sector, and we help supply the industrialization of the developing world as well. So if you look at sort of the 2020 range there at the right side of the graph, you'll notice that all 5 of these cycles were pointing down leading into 2020. And so we believe things are going to still be, you know, we had this correction in March, but things are still going to be choppy for the next couple years. And so we realize that progress is exponential. It can be aggressive and exciting, but problems arise when we think that, you know, things are just going to keep in that upward trend, and that good times never end. Progress is also cyclical, and life, as I'm sure we've all experienced, has its ups and downs. And the good news, though, is that if the good times end, so do the bad times. And just to reinforce sort of the positive in that, you know, when we look back at those seasons that we reviewed, if we're in winter now, you know, the world isn't ending. This crisis will pass. We've been through other crises, and you know, the cycles are turning up. And if we're in winter now, you know, spring is just around the corner. And you know, we also want folks and clients to remember too that just because there's cycles, it doesn't mean that you have to necessarily personally experience the brunt of the downtrend. So if you're structured right from the beginning, it should be more like a staircase, and so you shouldn't have these big peaks and valleys. So how you're structured has a big impact on you know, how a particular crisis will or won't affect you. Your experience doesn't have to be the same as everyone else. So the idea is to get out near the peak and wait, and then get back in near the bottom and ride the wave up, and then repeat that. That's really what we're talking about, is trying to mitigate some of these big peaks and valleys. So the good news from an economy and a generational standpoint is that baby boomers had a lot of children, and so although we're having a tough 2020, there's some good things to note about 2020, including that it's the year that marks that the millennial generation spending power is greater than any other generation on the planet, and they have more discretionary income than ever before. So just in North America alone, there are 79 million baby boomers. So when you combine Gen X to the millennials, there are 120 million of them. So that's a lot of peak spending that's ahead. So if we look back at the baby boomer generation, when they entered their peak spending years between 1982 and 2000, markets increased 12-fold. So globally, millennials make up 25% of the world population, and 9 in 10 millennials live in emerging markets. And so we're facing the emergence of 3 billion new consumers worldwide, and they're all producers and savers. And so when you put this all together, spring is coming. So I'm sure everyone's very interested in kind of what you can do to position yourself to win. So first and foremost, like, you know, at ITI, we're not investment brokers or investment advisors. We have a team of folks that manage clients' investments. We're heavy on the planning side, and we're planners. So we believe that the greatest predictability in your life comes from a solid structure. And so this is built around your personal self-discipline. So maybe those disciplines are good, they're bad, they're ugly. It doesn't matter what your disciplines are. We just need enough time to learn you. And then we build a properly diversified structure around you. And so we kind of look at true diversification, I think, somewhat differently, in that it's across 3 different asset classes. So you, property, and paper. And so in our view, you're number one. So whatever you do to create your income, whether you're an individual or a business owner, that's your most precious financial resource. So you as an individual, or you operating your business, you're your greatest asset. Then we want to protect your income from anything that can wipe it out. So anything like an illness or a death. And then this is where we're keenly focused, is then on killing the tax. So if you think about what your biggest expense is for everyone, typically it's tax. And so there's only really 4 things you can do with tax: pay it, defer it, reduce it or kill it. And so really starting with killing tax is where we prefer to start. And, you know, right now, every day governments are announcing bigger and bigger spending plans, and that's really code for taxes are going up. And, you know, it's likely to be an attack on our business owners again. Just in October, the IMF estimated that COVID-19 pandemic costs would exceed 28 trillion globally. And a study out of Harvard estimates that the economic cost will be about 4 times than what we experienced in 2008, 2009. And then from a Canadian perspective, the federal budget deficit for fiscal year 2020-2021 was projected at 343 billion just this past July. That's 10 times the 34 billion deficit projected before the pandemic. So we've got to pay for all this somehow. And, you know, the work that's needed to recover from COVID-19 and the pandemic is really something that we can relate to sort of war scale expenditures. So if we look back historically, many times taxes have been implemented to pay for wars and to provide protection. And so when we're looking at this kind of magnitude of expenditure, you know, 10 times the typical deficit that we would experience, I think it's safe to say taxes are going up. Then comes property. So we're talking about real property here, typically investment property. This could be residential or commercial. This is really the only place you can put a small percentage down and have tenants build your equity by paying off your mortgage, and then you get to write off all the interest and expenses and depreciation off your personal income. So the last big boom in real estate occurred with the baby boomers and their trade up homes to accommodate their growing families. And this was really during the 90s and then leading up to the 2008 financial crisis. So, you know, during that time, there was a lot of capital appreciation, but really what we're seeing today is it's more about buying property for the rent, the mortgage pay down, and then the tax deductions that you can realize. So a lot of the tax deductions that are available outside of what we typically have available to the average individual is really for business owners and then property owners. So we see a lot of business or a lot of value on the property side of things. And then next big boom we see is going to be in paper. And this again is tied back to demographics. And when those 120 million people in North America and 2 billion people worldwide enter their peak spending years. So we're expecting to see a similar run to what we saw when the baby boomers entered their peak spending years. And then we're heavily focused on value. And so this is really an area where our portfolio managers are focused, and we're well aligned with their methodology. And it's really around how you enter the market. And, you know, if you think to any experience you've had shopping at a dollar store, just because it's cheap doesn't mean it has any value. So there's a lot of, say, stocks that are on sale right now. It doesn't mean that they're of value and something that you should be adding to your portfolio. So building a portfolio from a value perspective requires certain disciplines. And so when we're looking at companies to buy, it's fairly simple. We look at first the demographic focus. So is this particular company, are they taking advantage of demographic trends? does this company have a good track record? So not necessarily looking at things like tech startups and that type of investing. We're looking more from a value perspective at those companies that have proven track records. And also their leadership. So who's running the company and do they put their shareholders first? Another important factor, especially during tough times, is businesses need holding power. So we look at the amount of debt they have. So we're looking for companies with little to no debt. And then dividends. Dividends mean that the company is profitable and investors are getting paid for their ownership. And then lastly, with the significant role that emerging markets play, is the company able to take advantage of the growing demographics in those emerging markets? And then we want to buy when it makes sense. So once you find this company that sort of meets these other criteria that we just went over, can you buy it on sale? So one of the 7 rules of investing is always to insist on a margin of safety. So we're looking right now at stocks being 30 to 50% off, and the sale's begun, but we still need to be cautious. Again, not just because everything's on sale doesn't mean that we should buy it and that it holds value. So we want to imagine a time, right now social media is lighting up. Everything on the news is lighting up with fear and a lot of focus on the virus and over the stock market crash, over government debt and everything else. But we're not just driven by fear. We're creative, we're innovative, and particularly when the pressure is on. So, I mean, we've seen this over the last while as businesses continue to pivot and adjust to the new normal. So we don't want to ever bet against the creative power of humanity. We're gritty and we're solution oriented. Demographics are on our side. So looking back in history, the role that demographics play is predictable. And so there's a certain reliance we can put on it looking forward as well. And so we don't want to be consumed by fear. We want to make sure that we're looking at the opportunity that's ahead. And so we prepared for this. We are prepared for this. And it's a time to get structured, really to withstand the wave of taxes that's coming. And again, this can be expected, as we've seen in the past, that the focus will be heavy on business owners again. And so we really want to look to put to work some of the tools we have to prepare and respond. On the tax front, the idea is to really try and mitigate paying any more tax than you need to and redirect that into your business or other areas of your planning. And so if we don't target tax, we're leaving a lot on the table that's really ripe for the taking. And we believe that individuals and businesses can spend their money and the hard-earned income that you generate better than the government can. And so that's a heavy focus. So that's a key area looking forward, is really to mitigate the downside, be cautious about entering the market, and then focusing on what you can do about your tax now and in the future. So that's the end. That concludes the formal part of the presentation. Just going to bring my video back.
Awesome. Thank you very much, Rhona. Really, Really appreciate that. I'd like to open up this. I'd like to open up this part for some Q&A. I encourage people to unmute their mics if they have any questions. Kind of put it in this format so we could have an open conversation. And Rhona is here to answer any questions that you may have. All right. Are there any recommendations? Oh, sorry, go ahead, Rhona.
I was just going to say, if there's any questions that anyone has that they want to reach out to me directly about outside of this forum, if there's anything sort of specific to your own situation, my information's on the slide there. And then I think there's something going out after as well. So, you know, feel free to reach out if you have something specific that you want to ask. Happy to answer your questions. And there's certainly no cost in you doing so. So don't let that hold you back. But certainly if there's anything that we discussed today that you have questions about, please feel free to ask.
Awesome. Thank you, Rhona. I guess the question for me is for people, I guess, who aren't as financially savvy as yourself, where would be a good place for us to start? Would you recommend us by kind of jumping in with a planner like yourself right away, or what do you think first steps are for someone who wants to kind of I guess choose their financial freedom in the future, and how would we go about doing that?
So I think there's a misconception out there often that working with an advisor is only for the wealthy, and you know, maybe only for the top 1%, and that's really not the case. Having spent 20 years in the North, I used to think you know, that just the North was underserved, but you know, as I work across Western Canada and now living in the Okanagan, I can see that, you know, everyone in really every jurisdiction is maybe struggling with the same issues and receiving quality advice. And sometimes you don't know what you don't know. So since working in this field over the last number of years, you know, I come across business owners and individuals all the time that say, you know, why didn't I know about this? Why am I 50? Why am I 40? Why am I 60? And I've never heard of this before. And so it's, you know, unfortunately, not all advisors are the same. And, you know, there's a broad range of skill set amongst financial advisors. So there isn't a lot of control around who can reference themselves or call themselves an advisor. And so the skill set that's available is quite broad and wide ranging. But I think, you know, there's really, if there isn't a cost in exploring opportunities, then it's really only, there's really only upside available, you know, to kind of explore maybe some new ideas that you didn't have access to or didn't know existed. You know, there's, I think this last market correction was a bit of a wake-up call for some that maybe enjoy, you know, self-directed investing and that kind of thing. And many of us are busy and we don't have time, you know, to, you know, commit as we should if we were, you know, had all of our retirement funds and all of our emergency savings and whatnot, you know, under our own investment management. It's often best to, you know, particularly with retirement savings and any kind of estate planning, to leave that to the professionals and, you know, maintain some, if you're interested and you like to dabble in some self-directed, you know, keep some money aside that you can do that with. But, you know, I think there's value for sure in working with an advisor and kind of exploring any number of areas. And I think in the case of taxes, I don't know anyone that really enjoys paying income tax. And so if there's a way to pay less income tax and not have to find new money to save, you know, that's a win right there.
Awesome. Thank you very much. Is there any other questions today before close off here? Well, Rhona, thank you very much for joining us today. Really appreciate it. As she mentioned, we are going to be sending out the recording as well as Rhona's information and a follow-up either by end of day today or a little bit later this week. So we will have that information out to you. And if there's anything else, please reach out to Rhona. I know that it's will be something that I'll be doing on my end. So
thanks everyone. Thanks for taking the time.
awesome. Thanks everyone. Have a great day.